Hi, this is Mark Pizzacalla and welcome to 3 Minutes with Mark for the first time in 2023. The year is young, but the action has already started, and we've had a really important case in January called the Guardian decision. The Guardian decision involves trusts, it involves distributions, tax planning, so it's got all of the characteristics of a tax thriller. Let me explain to you how it works and why the tax office got so concerned about it. So essentially what would happen is that you would have a trust, it would make a distribution to a company, that company would pay tax, and it would then, in a subsequent income year, make a franked dividend distribution back to the trust, and the trust would then distribute that in the subsequent year to a non-resident individual beneficiary. And the whole point of that, well, when I say the whole point, one of the outcomes is that essentially the income only gets taxed at the company rate, not at the highest possible non-resident individual rate. So you're missing out on the top-up tax. So there was a lot of excitement from an ATO perspective around this, and the ATO relied on a couple of really important provisions in the Tax Act, being a couple of really important integrity provisions, being Section 100A, which is a reimbursement agreement provision, and Part 4A, which is a really important anti-avoidance provision. Now, with the reimbursement agreement, basically the ATO was arguing, look, a reimbursement agreement actually involves a situation where there's money that's being provided to someone other than the beneficiary that was entitled to it. So the ATO is essentially arguing, look, you know, the distributions are being made one way, but the whole point of this exercise is that it ends up in the hands of the individual who is not paying the right amount of tax. Importantly, for this section to come into effect, you need to have an agreement between all parties, and the ATO was not able to identify that such an agreement existed. So it was really key, a really key point. Usually these types of arrangements, you could argue also, if they relate to family and commercial dealings, they fall outside the provision, but the court didn't consider that, didn't have to, because there was no agreement in place. In relation to Part 4A, well, the court said, look, in the first year where this happened, there was an evolving structure. We don't believe there was Part 4A involved, that the taxpayer was trying to get the taxpayer entered into this for the dominant purpose of obtaining a tax benefit. But by the time the second year rolled around, it was pretty clear what was happening, and we think Part 4A applied. So look, if you're making distributions, if you're doing some tax planning, please have a read of this case, critically important because it is an ATO focus. Speak soon.